The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Your host of Money in the Morning. And you know what? What's that smell? I love the smell of money in the morning. It smells like victory. Oh yeah, I've been saving that one up for a long time. Good rainy Monday morning. You're listening to LI News 103.9 FM. I'm your host, Mitch Goldberg. If you didn't know it by now, my name is Mitch. Okay. So anyway, we've got a couple of quick things to talk about. Let's just jump into the business day, okay? Looking like the major averages want to continue Friday's rebound. So Dow futures up about 90, S&P futures up about 6, NASDAQ futures up about 21. These are small little gains. Oil is up 97 cents to 82.43. That's West Texas Intermediate. The 10-year yield is 3.59%. In any event, what I want you to understand here is when you're listening to the show, it's not an infomercial. We're just here to educate you. And what we want to do is to help you become the best possible version of your financial self. We can all use a little help with the money, because it's easy for our money to control us as opposed to us controlling our money. It happens. So what we want to do is take a look at a couple of things. So the Dow year to date is up 0.69%. S&P is up 3.5%. NASDAQ up 6.4%. The real estate ETF IYR, that's the iShares, that's the Standard & Poor's Depository Receipt that tracks the real estate sector. That is up 6.25%. Emerging Markets ETF EEM is up 10%. And we enter the week with a yield on the 10-year bond at about 3.1. Let's see. The yield on the bond, I have a better way to look at that, at 3.53%. And bonds are actually having a pretty good year this year after having their worst year ever last year. So investors are looking for direction. Are we going into a recession? Is the Fed going to pause or pivot with their interest rate hikes? So that means is when the Fed finally gets to their terminal rate, when they say, okay, we think the risks to the economy are about even with upside and downside, and we think we've got inflation under control, we stop raising rates. That's the pause. The pivot comes after when the Fed starts to cut rates. Now, being that the Fed is data dependent, they're always behind. They're always reacting to last month, last quarter economic statistics. So it's hard for the Fed to be ahead because the Fed is no better at being a fortune teller than you and I. I do think they've got a better educated guess than most. But you know what they say about educated guesses? It's an assumption. And you know what happens when we assume, right? So we've got a couple of things to talk about. Earnings this week are coming out for Microsoft, IBM, Tesla, MasterCard, Johnson & Johnson, et cetera. So we're going to be taking a look at all of these. I think the Tesla earnings are going to be the most exciting because, you know, Elon Musk is such an amazing character and he's so interesting, and we want to see how he's managing Twitter and Tesla and doing all these things, and they just cut prices on their cars and they're trying to move metal. Congratulations to Tesla. You've become a real company. You know, a little fun fact about companies, okay, about stocks. Sometimes stocks actually trade on the dream, not necessarily on the real company. They dream that they'll become a real company. But once these Teslas of the world and other type dream companies become real, then they're valued like their peers. So once Tesla is valued like an ordinary automobile company like GM or Ford, you realize that the stock is way overvalued if it is to be valued like its peers. And it could be what's happening right now, which is why the stock is in the tank. So these are the things that we talk about on the show. The Fed's next meeting is January 31st and February 1st. It's a 2-day meeting. February 1st is on a Wednesday. It's the first Fed meeting of 2023. And it's about 99% expected that the Federal Reserve will raise its Fed funds rate, short-term rates, by a quarter point. That's perceived as good news because the Fed's been going 4.75 hikes. Now they did a 0.5 hike in December. Now they go down to a 0.25. And people think that means the Fed's getting ready to finally pause its interest rate hikes because inflation figures, retail sales, manufacturing figures, these have all started to moderate. They've actually been coming down. And there's a pretty big school of thought on Wall Street and in the economist world that not only is inflation coming down, that it could actually go flat, maybe even negative. There are so many predictions, though, and I do hear very smart people say, no, the Fed's got a long way to go to get inflation to their target rate of 2%, so they have to keep, hitting the brakes, tapping the brakes, slamming the brakes, whatever you want to use, it's all hyperbole, to slow the economy. It seems that's the national pastime, is forecasting the Fed's next move, and investors are searching for the direction of the stock market. So 2 weeks ago, we were very happy. The market was rallying. Last week, markets went down pretty substantially. The Nasdaq was up a little bit, but the Dow and the S&P were down. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Just have to get that out there. But I call this market right now the Billy Joel market because it's always sadness or euphoria. You know the song, right? You live on Long Island, you have to know the song, okay? So companies are mostly beating earnings expectations so far this quarter. So far. The expectations of earnings have been lowered, and it's usually about 80% of companies beat earnings expectations every quarter. It's more about 70% of companies beating earnings expectations. That's a good thing that the earnings beats are there. It's a good thing that investors are starting to acknowledge that earnings have to start coming down, because if we're not heading into a recession, we're definitely seeing the economy slow down. It's in the economic stats, the Philadelphia, New York reports of manufacturing in our areas. These are slowing down. So are we going to have a mild recession? Are we going to have a recession that's just like hardcore, typical recession? Or are we going to skate by? Well, if you lose your job, you don't really care if it's a mild recession or not. It's a recession for you, and it's terrible. So these are the things we have to talk about, and we want to make sure that you are prepared for these things. We are going to be getting to a commercial break in about 2.5 minutes. So I just want to make sure I'm setting the tone for the show, because you are listening to Money in the Morning with Mitch Goldberg on 103.9 LI News Radio. And what I want to do is talk about a couple of things. With all of this information that I just regurgitated, I feel like I just vomited out all this information. What are you going to do about it? What are you going to do with this information? Are you going to hunker down? Are you going to live on bread and water? Let's talk about some logical things that you could do, because I think there is a bit of fear, and I have to say, I think fear sells. I think fear gets viewers, fear gets listeners. Certainly controversy does. But I want to take that out, and I want to really kind of logical, boring, couple of steps, walk down Wall Street in a boring way. So the first thing I'm telling people to do is make sure you have an emergency fund set aside. Personal Finance 101, folks. If you can set it aside, do it. I do know that for some of you right now, that might not be a possibility, but something like the average American has only like $400 of savings set aside. But you need to have some funds set aside in case of a layoff so that you could pay some bills while you are actually looking for a job. The next thing you could do is, I know this sounds crazy, but network. if you have your job, you go to work every day, you go home, and that's the end of it. Make sure you are keeping up with your connections. Make sure, I highly recommend you are active on LinkedIn. I highly recommend that you make sure you keep in touch with people, keep your network strong. And this way, when you need a job, you don't have to start networking because you'll be ready for a job. Okay, I hear the music playing. So let's let the music play. We're going to get into a lot more good stuff on the back half. The radio. And by the way, everyone out there, if you are watching this on social media, Facebook, LinkedIn, YouTube, hit me up with your comments, your questions. I love hearing from you. So if I see any questions, that'll be really good for the show. You know, when you ask a question, you do help everybody out. So if you have any questions, definitely ask me in the social media. And if you're just listening to me, it's all about you, right? The listener, all of you. So just a quick traffic and weather report. It's raining, so that means the traffic sucks. Okay, that's the traffic and weather report. Just want to get that out there. And if you're kind of running late to work and you're white knuckling the steering wheel because it's raining and there's traffic, next time, you just have to realize you have to leave earlier when there's inclement weather, okay? So we're talking about taking control if there's a recession and you're worried about your job. So the first thing is you need some cash in the bank. If you're not in the position to put some extra cash in the bank, what you need to do is just really, I hate to say it, but just go all out restrictive and stop any discretionary spending if you're worried about your job, because you're going to want to make sure you are mean and lean heading into a potential job loss. Now, some of you listening to me right now have no worries about a job loss at all, but some of you may. But even if you're very secure in your job, you should still have an emergency fund, of course. So if you don't have the assets for an emergency fund, at least cut spending immediately. Get rid of Netflix. Get rid of everything. Okay. You have to do this for a couple of months to make sure you are ready. You can always add these things back, by the way. People think when you cut something out, it's forever, but you can always get your Netflix account back. I mean, believe me, they would love to have you back. You also should continue to network. Now, if you're someone who's not accustomed to networking doesn't mean going to events at the Huntington Hilton, where you might see me often at events, but it means making sure you are in touch with your world, with everybody you speak with, whether it's charities you're involved with, whether it's your church or synagogue. Make sure you're maintaining relationships. That, might mean, being in touch with people on social media. Certainly, I think it means being active on LinkedIn. Make sure your resume is updated, so to speak, your job skills on LinkedIn. If you've earned any new certificates, completed a project. If there are other people in your industry, make sure you send out connection requests. Use LinkedIn. It is an incredible free service, and you want people to know who you are so that if you were in the position of having to network, you've already actually started. People seem to wait until they lose their job to network. The time to network is not when you need something. It's before you need some, okay? You're only as good as your network, and believe me, people will ask you for help too, so it's okay to ask for help. Another thing you should do is earn some kind of certificate. I'm a big believer in continuing education. Make yourself valuable to an employer. Make sure you are learning a new skill. Make sure you can show it. Maybe go on LinkedIn Learning or something that you took a class. You want these things on your resume to show that you are always learning new things, that you are keeping up with the latest technology, the latest business processes. These are the things that you should be doing if you were worried about a recession. We could talk about investing in the stock market, and I could say, I think you could be in this sector or that stock. And we'll get into all these things. But I think if you don't have the fundamentals of being ready for anything, you're really not ready, I think, in my opinion, to worry about the stock market or worry about which crypto to buy. I'm not saying you specifically are buying a crypto, but you know what I mean? People are looking for that Sunday punch all the time. And I think instead of looking for the Sunday punch, you should be doing things consistently to make yourself more valuable in the workforce. Now, I want to talk real quick about the debt ceiling. Okay. How does it feel to be pushed up against a debt ceiling? Probably most of you don't feel anything at all because nothing's really changed. So the debt ceiling basically is a legal matter that says how much Treasury securities, how much debt, Treasury securities are how we issue our debt in this country. We hit the limit of how many Treasury securities, how many bonds we could issue to investors to get their money, to borrow it, right? So whenever you buy a Treasury security, you're buying the debt of the United States. Therefore, you are a debtor. Your creditor, I should say. We're the debtor. So what you need to do is understand that the debt ceiling is not like a cliff, but a clock, or I should say a countdown does start. So what happens when we hit the debt ceiling is we need to raise it. Now, this is a political football here, and this could maybe trigger some of you, and that's not the point here. The issue is we have to raise the debt ceiling because that is going to help us, not just help enable us to pay for what we already spent money on. It would be like, having credit card debt and then saying, screw it, we're not even going to make the minimum payments. We're just not going to pay. So when you raise the debt ceiling, it's for what we already spent the money on. So we're obligated to do that. The idea now, I think, is raise the debt ceiling, but let's not wait to the last minute to have these debates of what we should do with entitlement programs and other spending programs. One thing going around that I hear is to maybe raise the full retirement age from 67 to 70 for Social Security. All right. And that would affect me. I'm 55 years old. So if you raise Social Security, the full retirement age to 70, if, maybe 68, 69, something like that, if that's what helps the solvency of Social Security and we are living longer, I know I'm willing to give that a go. I think it's a good thing to do. But if you do that, you're going to be, blasted for saying you're taking away people's benefits. This is a debate we have to have. What about Medicare, raising the Medicare age from 65 to 66 or 67? We want to keep these programs solvent. We want to help people. But if people are living longer and these programs have been around, so they're not living as long, I think it does make sense to at least take a look at these ideas and help these programs become more solvent. That's what I think. So anyway, when we hit the debt ceiling on Thursday, Janet Yellen, Secretary of the Treasury, sent a letter to Kevin McCarthy, Speaker of the House, and saying, please take care of this as soon as possible. I'm paraphrasing. We're going to take extraordinary measures to keep the government running, but we can't take in any more money, and we owe, money for things we already paid for. And what is affected could be Social Security checks, Medicare payments to your doctors, federal employee payroll, federal employee contributions to retirement plans, the pay of military personnel. Okay. And then we eventually get down to saying we owe interest payments on the Treasury debt. The United States has never defaulted on its debt. The Treasury securities is the safe haven of the entire world for their money. Governments and pension plans all over the world, companies put their money into treasuries. And that also helps us because the dollar is the reserve currency. You don't want the dollar to lose its reserve currency status to the world. We as Americans enjoy so many benefits by having the dollar as a reserve currency. Interest rates would be much higher had it not been for that. So we cannot if we default on our Treasury securities, meaning stop paying interest, that would create, in my opinion, a huge calamity for the stock market and the economy. So if you think interest rates like 7% is high for a mortgage rate, we could be a heck of a lot higher because no one will want to buy our debt, which means our debt goes down, our interest rates start to skyrocket. So that's what's going with the debt ceiling. Supposedly, we have enough cash on hand through June to not have to make any changes, but June is really the drop dead date when we have to start making adjustments, maybe not pay for national parks, close national parks, that sort of thing. So I just want to give you a heads up of what we're facing, and this will be the next big thing, I think, that follows the stock market around as either a tailwind or a headwind. We're going to find out very soon. Thank you for joining me. This is Mitch Goldberg. You're listening to Money in the Morning with Mitch Goldberg on LI News 103.9. Enjoy the rest of your day, and I'll see you tomorrow morning. Thank you.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and opinions